Welcome to Macroscope TV. I'm your anchor, Yuan. Today we will have three anchors to introduce and analyze three different breaking news for you. The first breaking news is trade consequences of Trump administration, reciprocal tariff on Taiwan. On April 2nd, the Trump administration announced a series of tariffs described as reciprocal, ranging from 10% to 50%, imposed on nearly every country in the world. Taiwan's reciprocal tariff rate was initially set at 32%, but was subsequently reduced to 10% for a 90-day probationary period. During this period, the Taiwanese government must negotiate the final reciprocal tariff rate with the Trump administration. So, what is a tariff? A tariff is a tax on goods that a country imports from another country. It makes imported goods more expensive, so people might buy more products made in their own country. For example, if the US put a 10% tariff on cars from Japan, it means every Japanese car sold in the US must pay extra money as tax. And what is a reciprocal tariff? A reciprocal tariff is when two countries agree to give each other the same or similar trade rules. If one country lowers its tariff, the other country will do the same. For example, if the US lowers tariffs on French wine and France lowers tariffs on American beef, that's a reciprocal tariff agreement. Both sides give and get something. And how will this reciprocal tariff directly affect Taiwan's exports to the United States? The answer is Taiwan's exports to the United States decreases. If the US slaps a reciprocal tariff on Taiwan's exports, like say 10% during that 90-day probation, that means Taiwanese goods become more expensive for American buyers. So Taiwan's export to the US will likely drop, since higher prices usually reduce demand. US importers might just look for cheaper alternatives from other countries. And how will it directly affect Taiwan's imports from the United States? The answer is Taiwan's imports from the United States decreases. On the flip side, Taiwan might respond with tariff on US goods, which would make imports from the US more expensive for Taiwanese consumers and businesses. So Taiwan's imports from the US will probably decrease too. Basically, both countries end up trading less with each other in the short run because of the higher costs on both sides. And what is the nominal exchange rate? The nominal exchange rate is just the price of one currency in terms of another. In this case, it's how many new Taiwan dollars you need to get one US dollar. So if the rate is 32, that means 1 US dollar equals 32 new Taiwan dollar. Then, how will the nominal exchange rate, new Taiwan dollars per US dollar, be affected by this reciprocal tariff? American demand for Taiwanese goods drops, cause supply of US dollars shifts left. But Taiwanese still want US dollars. So this causes demand doesn't drop much or might increase. And you can look at a graph. We will have a new equilibrium from change from E1 to E2 and have new nominal exchange rate change from R1 to R2. Overall, demand for new Taiwan dollars decrease and demand for US dollar increase. So the nominal exchange rate new Taiwan dollars per US dollars increases. Based on the graphical analysis, will the new Taiwan dollar appreciate or depreciate as a result of the reciprocal tariff? The answer is the new Taiwan dollar will depreciate because the reciprocal tariff from the US makes Taiwanese exports more expensive for Americans, and Americans buy less from Taiwan, cause less demand for Taiwan's goods, and less US dollar being exchanged for new Taiwan dollar. That means less supply of US dollar in the Taipei market, which pushes the exchange rate up. That means you need to have more new Taiwan dollars to get one US dollar. And how will this reciprocal tariff directly affect the United States net exports? Here are the formula. Net exports equals exports minus imports. The US puts a tariff on Taiwanese goods, cause Taiwanese exports to the US go down. But Taiwan also responds with a 10% tariff on US goods, even if it's a probationary one. That makes US goods more expensive in Taiwan, so Taiwan imports less from the US, and this causes US exports go down. And since there's no big change in US imports from other countries right away, the drop in exports is the main thing. So the US net exports decrease. What is the real exchange rate? Here are also a formula that real exchange rate equals nominal exchange rate times foreign price level divided by US price level. The real exchange rate measures the relative price of goods between countries. It tells you how many foreign goods you can get for a set amount of US goods, adjusting for price levels. It's all about the actual buying power of dollars abroad. How will it be affected by the reciprocal tariff? Because with lower demand for US dollar, it becomes cheaper to exchange into, so real exchange rate decreases. US goods become cheaper relative to foreign goods. In the long run, that could help US exports bounce back, but short run it's like less demand and weaker dollar. Because of the tariff, foreign demand for US dollar decreases. This causes the demand curve shifts left. So we can look at the graphic. We will have a new equilibrium change from E1 to E2 and have new real exchange rate from R1 to R2. The real exchange rate decreases because the tariff makes US goods less attractive abroad, so fewer people want to exchange their currency into US dollar. Based on the graphical analysis, will the reciprocal tariff actually improve the United States net exports as Trump expects? The answer is no. The reciprocal tariff won't improve the US trade balance in the short run. In fact, based on the graph, the tariff will likely hurt exports more than it helps, so the trade balance probably gets worse before getting better. Over time, the real exchange rate falls, which makes US goods cheaper to foreigner again, but that takes time. In the short term, the demand for exports is pretty inelastic. People and businesses don't just switch trade partner overnight. So even if the weaker dollar helps in the future, it's not gonna give that quick win Trump might have been expecting. And this is the end of my part. Let's hand it over to the next anchor, Pingwen. Mhm.
Thanks to our previous reporter for the update on Taiwan's tariff negotiations with the US. Now, let's turn to another key economic development. Taiwan's at the forefront of the AI boom. Economic impact unfolds. In 2024, Taiwan's semiconductor exports to the US and other countries surged at an unprecedented pace, fueling global demand for advanced technology. At the 2024 Taipei Computex, NVIDIA CEO Jensen Huang made a bold statement. Taiwan is now at the center of AI. This claim is reinforced by recent developments. NVIDIA and AMD, the two global AI leaders, have announced plans to establish overseas headquarters and R&D centers in Taiwan. Foreign investors responded swiftly, purchasing shares of TSMC, reflecting a strong confidence in Taiwan's economy. These advancements have contributed to a significant growth in 2024. But what does this mean in practical terms? How will it affect Taiwan's GDP, price levels, and government policy? I'm Pingwen, reporting from Microscope, bringing you the latest insights on AI impact on Taiwan's economy. So let's break it down using the aggregate demand and aggregate supply model to examine both short-term fluctuations and long-term effects on real GDP and price level. So for the first one, the impact of semiconductor exports on Taiwan's GDP and price level in the short run. So let me briefly introduce the aggregate demand and supply curve. Aggregate demand curve shows the quantity of goods and services that households, firms, and government want to buy at each price level, while the aggregate supply curve represents the quantities they choose to sell at each price level. The shift of AD depends on the changes in the components of GDP. So somebody may ask, what's GDP? So GDP is actually the market value of all final goods and services produced within a country in each period, including four major components: consumption, investment, government spending, and net exports. When the exports from Taiwan increase, net exports rises, causing the GDP to grow. This shifts the AD curve rightward, leading to higher output and potentially increasing the overall price level. The second one, effect of NVIDIA and AMD's investment in Taiwan. So there are two types of investment in general, the foreign direct investment and the foreign portfolio investment. The foreign direct investment referring to foreign entities actively increasing the domestic physical capital and is counted in GDP, while foreign portfolio investment refers to the financial investment, stocks and bonds that don't alter physical assets and do not affect GDP directly. Since NVIDIA and AMD are constructing the R&D centers, their investment qualifies as direct investment. This boosts the GDP, shifting the AD curve rightward and raising both output and price level, which has the same effect as the semiconductor exports. The third one, effect of foreign investors buying TSMC shares. So unlike the direct investment, purchasing TSMC shares is an example of foreign portfolio investment. It influences the financial savings, but does not directly shift the aggregate demand. Since aggregate demand is not impacted, Taiwan's real GDP and overall price level remain unchanged in the short run. So when Taiwan anticipates these economic shifts, the government faces two key options: taking no action or allowing the market forces to self-adjust, or intervening through the fiscal and monetary policies to influence the economy. So let's delve into each option. Firstly, which is the long run effects without government intervention. If there's no action from government, Economy its own will self-adjust by shifting the aggregate supply curve no matter in short run or long run. The short run AS curve is related to the cost of production and the willingness of firms to supply those goods and services, while the long run is related to the determinant of output, which are labor, capital, natural resources, and technological knowledge. In this case, firms will initially respond in expanding production due to the perception of increasing production profit. Therefore, the short-run AS curve will first shift to the right, which lower down the initial price level and increase by AD and increase the output level too. Over time, the AI growth improves the long-run productivity, shifting the long-run aggregate supply curve rightward, increasing the natural rate of output, and achieve the equilibrium point which three of the curves intersected, indicates the absolute increase of natural rate of output. But the final price level remain uncertain depending on the productivity gain versus the demand pressures. The second option, government policies to prevent economic overheating. So if the Taiwanese government is concerned about an overheated economy, for example, the asset bubbles in the stock and housing market, it may intervene the economy by using the contractionary monetary and fiscal policies to shift the AD back to its initial equilibrium, which is the natural rate of output and price level. Note that all such policies only affect AD curve, not the AS curve. So for the monetary policy, central bank may sell government bonds to the public. When these bonds are sold, the money supply decreases, causing a higher interest rate and makes the borrowing more expensive, discouraging the consumer's investments and consumption. As a result, the real GDP and price level declines, causing a leftward shift in AD curve. For fiscal policies, government may reduce their spending, directly affecting the government spending in AD curve. Besides, this reduction will induces the multiplier effect, impacting the consumption because contraction fiscal policy will decrease the consumer income, leading consumers and businesses to perceive a higher cost, discouraging their investment and spending. As a result, the real GDP and price level declines, causing a leverage shift in AD. Ultimately, the real GDP and price level are expected to decrease, but it leaves a question on whether getting back to its initial equilibrium, as it depends on the relatively strength on the demand contraction. So far, we have analyzed how AI-driven investment and semiconductor exports are reshaping Taiwan's economy. But beyond market dynamics, government policy plays a critical role in maintaining economic stability in the short run. You're watching Microscope News. This is Ping Wen, bringing you the latest insights on Taiwan's economic trends. Stay tuned as our next reporter will delve into the fiscal policy debate shaping the nation's future.
Hi, I am only one. Okay, now let me talk about the breaking news today, which is Taiwan's legislative standoff, and it is the budget battles between the parties. First, the opposition parties in Taiwan's legislative yuan have cut various government spending proposals submitted by the executive yuan, while the ruling party argues that these budget cuts will harm Taiwan's economy. The opposition claims they are helping the Taiwanese people by saving public money. Today, we're gonna see and analyze the situation now. First of all, let's see impact of cutting the government budget on Taiwan's GDP and price level in the short run. So we have to focus on the shift in aggregate demand curve. Let's see, AD is related to GDP, and that is equal to C plus I plus G plus X minus M. So C here is the consumption, I is investment, G is government spending, X is export, and M is import. So when the opposition parties in Taiwan's legislative yuan cut government spending proposals, the G, which is the government spending component of AD, decreases. This rivalry reduces aggregate demand in the short run. Hence, AD curve shifts leftward. And let's see. The real GDP, which is the output, has a low AD indicates that fewer products and services are demanded in the economy, resulting in a reduction in real GDP. So we can see that real GDP decreased. So how about the price level? So the reduced demand puts downward pressure on the price level, perhaps resulting in reduced inflation or even deflation. This depends on the magnitude of the cutbacks. How will the multiplier effect affect the economy? The multiplier effect describes how a minor shift in expenditure, such as government cuts or increases, may have a significant overall influence on the economy. For example, when the government reduces spending, people earn less and spend less, leading total income and output, which is GDP, to decline by more than the initial drop. So, multiplier effect has its formula, which is the figure shown below. We could see that the multiplier effect is equal to 1 divided by 1 minus MPC. MPC is marginal propensity to consume, which is the portion of additional income that households spend rather than save. And that is another formula, which is MPC plus MPS equal to 1. Although MPS is opposite to MPC, it represents the marginal propensity to save, while the meaning of MPS is exactly the opposite of MPC. In this case, the initial change is a decrease in government spending, which reduces aggregate demand. A higher MPC means a larger multiplier and a greater overall impact from the initial budget cut. Suppose the government cuts spending by $1 billion, and if MPC is equal to 0.75, the multiplier effect will be 4. Then the total decrease in GDP could be minus $4 billion. This is already much more than the original reduction in spending. Hence, the multiplier effect multiplies the economic impact of a budget cut. In Taiwan, the opposition's decrease in the government expenditure might cause a significant fall in AD, resulting in a larger than expected short-run decline in GDP and employment. How will the multiplier effects affect the economy? Let's look at the graph. First of all, we know that when the government spending is cut, then the AD will decrease too. So the AD will definitely shift to the left. So let's see. The first AD curve shifts to the left by 1 billion because a decrease in government's purchase of 1 billion initially decreased aggregate demand by 1 billion too. So we just like expect that there will just $1 billion decreases in the AD because the government spending is decreased by 1 billion. However, we have the multiplier effect in the economy. The multiplier effect can amplify the shift in aggregate demand. This will result in the decrease of the aggregate demand has a reduction by multiples. So the multiples, so the money will decrease. So the AD will shift to the left by minus $4 billion in total. Okay. So what is about to happen in Taiwan's vulnerable funds market? And how will these budget cuts directly affect public savings? First, let's look at the formula. Public savings are equal to tax revenue minus government spending. Since the opposition parties have reduced government expenditure, assuming that tax income remains constant, public savings will rise. This improves the government's fiscal situation. For example, this will help the government lower the deficit or raise the surplus. Then, what will be the effects on demand and supply in Taiwan's renewable funds market? Also, how will the real interest rate, private investment, private saving, and national saving be affected? The loanable funds market is the interaction between savers who supply money, represented by the supply curve, and borrowers who demand funds, represented by the demand curve. In the market, we know that supply of loanable funds equal to national saving and which equal to public saving plus private saving too. And how about the demand? The demand is equal to the private investment and net capital outflow. So in this case, public savings increase because the government is spending less. The supply of loanable funds increases because there is more national saving due to the higher public saving. Hence, the supply curve shifts rightward. How about the demand? The money supply of loanable funds increases, causing the interest rate to fall as more funds are available and the price of borrowing falls. As the price of borrowing falls, there will be more private investment. Hence, the demand for the funds will also increase. The demand curve shifts to the right. The private saving may decrease slightly due to lower returns or savings due to the decrease in interest rate, but could remain stable if income rises from investment growth. And the national saving will increases. The public saving rises. If private saving doesn't fall too much, national saving increases overall. So overall, in the short run, cutting a government expenditure increases public savings, which expands the amount of loanable funds, lowers real interest rates, and encourages more private investment. Then what will happen to Taiwan's net capital outflow? Net capital outflow, which is NCO, is the difference between the purchase of foreign assets by domestic residents and the purchase of domestic assets by foreigners. We call them capital outflow and capital inflow simultaneously. Its formula is shown below the graphs. So NCO is closely tied to the real interest rate. If that is a higher domestic real interest rate, then they will have a lower NCO because the capital stays home or flows in. But if there is a lower domestic real interest rate, then it will have a higher NCO because the investors seek higher returns abroad. So the loanable funds market determines the interest rate, and that is the graph. The left graph is the previous graph we have already discussed. So it like the loanable funds market determines the interest rate, and the final interest rate will work in the NCO markets, which is the right graph. So, based on the previous question, we know that the government spending cuts, which cause an increase in public savings, and this increase the supply of loanable funds, causing the real interest rate to fall. With the low interest rate, the domestic investors tend to seek higher return abroad, so the capital outflow increases. A lot of domestic investors now have more foreign assets than before. Meanwhile, foreign investors may find Taiwan's assets less attractive due to the lower returns, so they reduce their investment in Taiwan. This caused the capital inflow to decrease. Hence, based on this formula, when capital outflow increase and capital inflow decrease, and net capital outflow will increase. So what is about to happen in Taiwan's foreign currency exchange market? Since we have discussed the NCO from the previous question, so we know that Taiwan's residents are investing more abroad due to lower domestic real interest rate. So to invest abroad, they must exchange more NTD dollars, new Taiwan dollars for foreign currencies. This increases the supply of NTD in the foreign exchange market. So the supply curve of NTD will shift to the right. The real exchange rate falls with more NTD available in the market. The value of NTD depreciates. And it is like one NTD buys fewer foreign currency units. So the trade balance will improve because exports become cheaper to foreigners, and imports will become more expensive for Taiwanese, so imports will decrease. So the net exports, which has the export minus import, will increase. So what is going on in Taiwan? First of all, let's see the direct impact of reducing the government spending. G is one of the components in the AD formula. Let's see the formula. We know that AD equal to C minus I minus G minus X minus, AD equal to C plus I plus G plus X minus M. And C is the C is the consumption, I is the investment, and G is government spending, and X is export, and M is import. So therefore, when the legislative yuan cuts the G, there is an initial decrease in AD. So now, let's move on to the multiplier effect. The multiplier effect means the initial reduction in government spending leads to a larger total decrease in AD. Let's review the previous example. If the government spending minus decrease $1 billion and the MPC is 0.75 and multiplier effect is 4, then the total decrease in GDP will be $4 billion. So let's make an assumption. Like the result, if the government spending just decreased by $1 billion, but the total decrease in GDP will result in the decrease in the $4 billion, then this has already led to a larger than expected short-run decline in GDP and employment, because the multiplier effect will amplify the negative impact on AD. So how about the indirect effects of cutting government spending? Let's check it via the loanable funds and foreign exchange markets. Firstly, budget cuts increase public savings, shifting the supply of loanable funds rightward. This leads to a lower real interest rate, which encourages private investment, which is I. Then the increase in private investment contributes to AD, partially offsetting the reduction in government spending. We can observe this phenomenon through the increase in the quantity of loanable funds. Secondly, based on the previous graph, the loanable funds market graph, we know that the real interest rate has decreased. Lower interest rate cause more Taiwanese investors to invest abroad to get a higher return, and the foreign investors also reduce their investment in Taiwan for the same reason. Hence, NCO increases as capital outflow increases, and capital inflow decreases at the same time. When NCO increases, more NTD are exchanged for foreign currency, leading to a depreciation of the new Taiwan dollars. This makes export cheaper and import more expensive, improving net exports. This results in the AD increases due to stronger export performance. So, in summary, although there are positive indirect effects, which is investment and net exports, will increase, the initial decrease in government spending and the multiplier effect are expected to be more stronger in the short run. Therefore, overall, Taiwan's aggregate demand is predicted to fall as a result of the legislative US budget cuts, and the magnitude depends on the size of the budget cuts, the MPC in Taiwan, which affects the multiplier, and the sensitivity of investment and exports to changes in interest rates and exchange rates. So today, thank you for your listening, and this is all. Thank you.